Hello, good evening, doctor.
Hi, sir. So
Hi, good
we are
evening.
starting the webinar now. Good evening,
Okay.
everyone. I am Dr. Anamika, the Academic Secretary of KEMR. I extend a warm welcome to all of you to today's webinar on financial literacy, jointly organized by KEMR and BMC-MAR. Today, we are privileged to have CA Santosh Kadam sir with us. He is a distinguished chartered accountant who operates CAS Consultants, a multi-family office in Thane, catering to clients nationwide. Additionally, he leads Wealth Secrets, a reputable investment advisory firm. With over 25 years of experience in financial markets, specializing in equity and debt, Santosh Kadam sir has held senior positions at prestigious institutions such as ANZ Greenlist, Bank PLC, Birla Sun Life Mutual Fund, SBI Mutual Fund, ILNFS Mutual Fund, and UTI Mutual Fund. He has been instrumental in pioneering innovations such as floating rate bonds, debt funds, equity funds, and balance funds. His contributions extend to representing mutual funds in AMFI and SEBI committees. Beyond his professional achievements, Santosh Kadam sir is actively involved in various roles, including club president, TRF director, club mentor, treasurer at club level, avenue co-chair for de-addiction, CSR director, deputy director membership, and disease prevention. On a personal note, he is married to Sukada, Master of Commerce and homemaker, and they are proud parents to two accomplished children, Shariu, who is pursuing CA and law after completing a Bachelor of Commerce, and Shardul, a chartered accountant with a master's in commerce, currently working at KPMG and pursuing chartered financial analyst credentials. So, without further delay, over to you, sir.
Yeah, thank you, Anamika ji. I'm going to share this my screen. Uh, yeah. So I think screen is visible, isn't it, Anamika ji?
Yes, sir, it is visible.
Fantastic. I'm also my voice is also clear, correct?
Yes, sir, it is clear.
Okay. So thank you, Dr. Anamika ji. Whatever introduction that you did, I think I had sent it. So, but it is my proud privilege to be associated with KEM and particularly you. And thank you so much for following up so much. I've been chasing so much for me for doing this. And thank you, Rahul. Also, I believe he's also around. So, friends, without wasting so much of time, see, as a doctor, I'm sure you're building immunity to the whole health of human being. As chartered accountants or maybe as financial advisors, what we do, we add financial immunity to almost everyone. And both are important. By the way, health is wealth and wealth is health. So, what is financial immunity as a, as a topic suggests? Financial immunity empowers you to conquer the challenges that that have been thrown upon to you because of the economic reality which is all around us. And being financially immune has become so much important in today's world, and it has become an ultimate need of an hour. Reason being because if everything is now controlled by money to an extent, and the future is of course uncertain. Now, if you plan well, if you have a concrete plan to wither these challenges which have been thrown at you, particularly financially, I think you can sail through quite well. I think the financial immunity has these five aspects: the challenges which has been thrown at you, the economic surroundings or the economic reality around us, and what is the need today to encounter this particular reality. And of course, the future is uncertain, so we can't predict future. And how to go about the planning this particular financial immunity. Now, as an individual, I'm sure you and I are facing these financial challenges in our life. All of us want a good retired life. All of us want our daughter, son, their higher education to be taken care of well without any financial trouble. Even we need to marry them off also well. Everybody needs a house to stay, whether it's a primary house or a second home, maybe at a exotic location. We all are so stressed out, especially all of you doctors. I think you all work 24 hours sometimes. During COVID times, we have seen that I've seen some of my friends not even slept for 2 to 3 days, at a stage, and it's a really really stressful life. So obviously, you need to unwind yourself. You need to go to the holidays, and of course, I know you are taking care of everybody as far as medical is concerned or emergencies are concerned. but your own medical provisions you need to make, and you also need to make provisions for your own emergencies. Now, unfortunately, all of this cost money, correct? So now, where this money can be created, or where this money can, come in, because whatever you earn as a salary or stipend, or for that matter, even a business income, now most of it or substantial part of it goes into your, daily needs, and you can save only a little bit. So from that little bit, how can you create a wealth? Now, for creating wealth or for investing that money, you have very limited options: equity, real estate, fixed income securities, commodities, cryptocurrencies, and art. Now, if you look at the options that are available, equities are the only option where you can invest a little bit of money. Real estate, you need a lot of money. And in real estate also, there's an issue of liquidity. Like you have bought a house, let us say of 1 crore rupee, and you need a 25 lakh. Now you can't sell one bedroom for 25 lakh, and the rest of the house you can keep it to yourself. But so, you have to look at liquidity. You have to also look at the taxation aspect into it, and you have to also grow uh, beyond certain, like, at least you need to beat inflation. So all these options, we will look at it briefly, but equities are the only option which you want to cover it slightly in length. So while you are investing, or while you are looking at the options to invest into, you're going to look at what are the returns which are going to come across, which are going to come from those investments. Like for example, equities, uh, it has grown tremendously for last 45 years. Even real estate for that matter has given good returns, but liquidity is a problem. Taxation is, I'm going to explain it later. Taxation also is a problem with real estate. Now that this particular budget, which has been passed by Sitaramanji, now there she has removed the indexation benefit, which was an adjustment for your inflation, which was there earlier. Now that has been removed. So you want to pay flat 12.5% tax on the money that you make on real estate. Liquidity, as I explained just now, that in real estate, if you want to sell a house or a plot of a land, or even a shop for that matter, all this classifies as real estate. It takes a lot of time to sell. You can't generate money overnight from real estate investments. Transparency, like, there is no pricing transparency in real estate, for that matter, most of the assets. Now, there's transparency is only available on equities, because the equity stocks, or the share market, or the companies which are listed as stocks. Now they are traded on an everyday basis, so you get these stock prices almost on a almost on a second basis, depending upon the market hours. Now, ease of doing transactions. Just imagine if you buy a house, the amount of legwork that you need to do. You need to identify property. You need to first identify broker, then identify area. Within that, identify property, and then you deal with real estate brokers and the seller of the property, and then you come and then do a lot of negotiation, and after that you go to the registrar's office. A lot of things. I mean, it's a cumbersome procedure that you have to follow, and of course the record keeping. If you lose out, property documents, then the process is even tedious in terms of getting those duplicate documents and even property papers again. So considering all these issues which are there in every asset class that we mentioned earlier, I think equities are the best bet and best option to make money, to save on taxes. It is even more liquid. Liquid, why I'm saying so? Because you buy today and say you want to sell it today, you can, or you want to sell it after 3 months, you can sell it and you get money back in 2 days, 2 working days. Transparency, as I mentioned, that you are investing in businesses. So all the companies that are listed on stock market that we invest in, they are governed by certain regulations, either Companies Act or SEBI or corporate governance, and they all are transparent in terms of telling you as to what they do with your money. Ease of doing transaction, you can just open an account nowadays. So it's all open, it's all online. So either Zerodha or any such platforms, you open the account, it happens in probably less than a minute time, and then you are ready to trade. Now, why I'm saying equities are the best bet, even from a return point of view. Now look at this chart. This is the last analysis of last 30 years of returns that are generated by different asset classes. Now, see the inflation, that blue bar that you see, it's a 7%. Last 30 years, the average inflation has been 7%. Now, if you have invested in gold, gold has generated 6.8% return. Fixed deposit or bond, which is fixed income securities, have generated 9.1% return. But equities, that is the red cube that you see, has given returns or has generated return almost 16.7, that is 17% annualized for the last 30 years. And mind you, I have not accounted for taxes in it. If I account for taxes, then FDI and gold has not given return even in line with the inflation. Equities are the only one who have beat the inflation. What I meant by inflation and beat the inflation is, for example, if I have today 100 rupee, and if this pen is going to cost, say, 100 rupees, I am going to invest this money, let us assume that in bank fixed deposit, and I'm going to make, say, about 109 rupees out of it next year. Now, next year, when I want to buy this pen, that pen already has, because of inflation, it will cost, say, 112 rupees. But I have only 109 rupees. So inflation is killing silently, and it is making me poorer and poorer. And therefore, it is at most important that I invest into all the instrument or all the options where I generate return post-tax basis better than inflation. And I think equities are the only best bet or the best option that to generate that kind of returns. Now, I have included this slide after speaking to Anamika and some of my friends that a lot of people are, particularly youngsters, now they are getting fascinated by investing into cryptocurrencies. So I thought, why not I take the opinion of one of the most successful investors in the world, which is Warren Buffett, who manages close to about 8,91,000 crores of assets. I mean, that is his wealth. Now, what he says that, Bitcoin is a delusion and a rat poison. And he has, last year only, he made an official statement that he will never invest in cryptocurrency, arguing they attract charlatans and basically they have no value. Warren Buffett also has said, this cryptocurrencies are worthless, and this is supposed to be the only speculative asset that you should stay away from. Because, reason being, cryptocurrencies, they don't have any underlying value. They don't produce anything. They don't have underlying value. Like, for example, if you're investing in a stock, say, for example, Reliance. Now, Reliance has a business. So it has an underlying value of that particular business, and they're generating or they're producing some, like, for example, oil products, or they are into financial services, or they are into, say, telecom. They're producing something, but cryptocurrencies aren't producing anything. So I think if largest investor who's been successful investing for last 80 years, if he says so, I think he needs to take that advice blindly and stay away from, cryptocurrencies. Now, this is a chart, just coming back to the equities. Now, our equity index started somewhere in 1979, 80 at 100. So this is the last 40 years chart. But now if you add another 5 years, that is, make it 45-year chart, 100 rupee in 1979, 80 has become close to about 82,000. So today's Sensex is around 81,000 something. So 82,000. So irrespective, and during this last 45 years, we have seen so many governments toppling, new government coming in. Everything has happened. We have seen scams. We have seen everything. We have seen Gulf crisis. We have seen war. We have seen Lehman Brothers crisis in 2008, 2009. We have also seen some of the medical epidemic kind of situation, which is like Corona crisis. So we've seen everything possible in last 45 years. Despite that, stock market has given close to what 18%, per annum kind of returns. The compounded annualized growth rate is almost like 18% in this from this market in last 45 years. And that is amazing. And that's the reason why one should invest into equities. Now, I wanted to bring in this concept of, I know I'm talking to the medical fraternity, so you all will not be as savvy as probably the financial experts, but I'm sure you would have done maths at some point of time in your life, and that this is something which you have been taught in 6th standard, by the way. Those who have done in Hindi medium, probably wo Chakravarti Vyaj bolte hai usko, and those who have done in English is called CAGR. And this effect of compounding, it really works well. Best mind called Albert Einstein, he says, those who have understood it well, I think he earns it, and those who don't, they pay for it. And the example of this is this. Now let us consider Santosh, that is me, and Dr. Anamika. Now just imagine Anamika thinks, Anamika says that I will invest first 10 years only. Okay, 10,000 rupees every year she is investing for the first 10 years. So that is a total investment that she has made is 1 lakh rupees. So this is where, if you can see the pointer, so 1 lakh. Okay, and 15% per annum she makes at the age of 65. When she pulls out this money, her money has grown at the rate of 15% to 1 crore 34 lakh 43 452. Whereas I say I will not invest for the first 10 years. Reason being because I want to enjoy my life. Okay. I want to enjoy my life because I've worked really hard for doing chartered accountancy. Like unlike Anamika, so I'm sure she would have worked hard for 10 years, but she chose to invest. But I said, let me enjoy. And but rest of the 30 years, I'm going to invest 10,000 rupees. Okay. So that is 3 lakhs rupees. Okay. So that is almost thrice the amount that what Anamika has invested. And at the same security where she invested, so I'm also earning 15%. But look at the value at the age of 65, both of us. Despite investing thrice the amount, I have 43 lakhs rupees, where she has 1 crore 34 lakhs. And friends, this is only because of power of compounding. Because longer you give money to grow, I think the power of compounding was is the works like eighth wonder, and that's what the Einstein said, that it is the eighth wonder in the world. Now let's take this example a little further. Okay, now same example. What happens? Anamika has been investing 10,000 rupees per month now for the 10 years, for the till the age of 60, that is the retirement age. So 10,000 rupees every month invested at 15%, it becomes 14 crores. Whereas I have started investing, as I said, 10 years enjoyment, and from the age of 35, I'm investing for the rest of my life. And I said, this time I want to be better than Anamika. So I'll invest double that, twice the amount what Anamika is investing for the rest of my life till the age of 60. So I've invested 20,000 rupees at 15%. Now my value, terminal value, or the investment value at the age of 60 becomes 6.48. So what has costed me by that 10 years of delay is 8 crore 19 lakhs. So friends, I think all of you listening to this webinar should start investing today. Whatever small amount is, I think you should not delay, because this once you delay, I think the cost is going to add huge. Now, while you're investing, these are the two rules that you should follow. I think it's very simple rules, and these are the rules. See, I've been very, influenced by Warren Buffett, and this is his rule only. Rule number one: never lose money when you invest. And rule number two: never forget rule number one. And what is that? Why it should be? Like, just imagine 10,000 rupees that you want to invest or have invested. It takes 7 years to double that money at 12%. Now, if the same money, if you invest and if you lose 20%, suppose if you have bought any particular stock and that stock has come down to 20%. Now, what has happened? That 10,000 has become 8,000. So you lost 20%. Now to double, it will take 10 years. But somebody who follows that rule of not losing money, he is ahead by 3 years. And just imagine the power of compounding when it works longer and longer. The difference between these two individuals, the one who loses and the one who doesn't loses, will be huge. Now, since you don't want to lose money, so obviously you need to understand as to where to invest. Now, this is a very classic line that price is what you pay and value is what you get. Now, just imagine if any of you using iPhone. Now, iPhone cost you 1 lakh rupees. Yeah, everybody knows that, the price of iPhone, let us take, it is 1 lakh rupees. But if that same iPhone is available at 20% discount at 80,000 rupees, you think what is the value? So it becomes value is 80,000 and the price is 1,000. So, when you want to buy stocks also, you need to understand what is the value of that business, the underlying value I'm saying. Like, for example, any business you take it has a value. Like in a hospital, like for example, all of us, we value hospital based on the number of beds that particular organization, that company has. Like now your Jupiter Life Sciences also is listed, and then Krishna and all, some of the hospitals. The way we look at is number of hospitals and number of hospital beds, and then from that bed, what is the revenue that has been expected. So we take total revenue, and then we apply certain formulas. In our technical language, we do DCF valuation or a price cam model, and then we'll arrive at a value. Now, if that value arrives at a per share, say 100 rupee, and if the stock price is 200 rupees, so 200 rupees is what you're paying for the value that you're getting of 100 rupee. Now, I think any sane person will not go for it unless this matches or unless the price is lesser than the value. Now, that is what exactly I've explained in the next slide, which is the intrinsic value. Now, I'm not going to get into technical, very simple. As I explained you, if value is more and the price is less, that means that stock is undervalued. Agar value 500 rupees hai, and if the stock price is say 400, that means it is undervalued by 100 rupee, and vice versa. If the value is 100 rupee of that stock and the price is 200 rupees, then I will not buy that stock. I am going to only buy those stocks which are undervalued. And that is exactly what Benjamin Graham tells everyone. And this is the guy who's been a guru of Warren Buffett, Charles Munger, or Philip Fisher, and all of those. There's a book called Intelligent Investor. I think you all must read that book. I know that book is a little technical, but you must read to understand this concept, which I've just explained. These two slides of value investing and intrinsic value of a business. While you invest, after you understand the business, what is the value and what is the price. Now you all should invest only for long term. See, there are no shortcuts. To become a doctor also, I'm sure it takes 4 years plus. To become MD, another maybe additional 4-5 years, and to become a known doctor, to 20-25 साल लगते हैं. So similarly, there are no shortcuts in life, and same holds true even for the investments. So if you aren't thinking for owning a stock at least for 10 years, don't even think of investing that stock for 10 minutes. Don't. So invest for long. And what is the benefit of identifying good business, identifying value, and therefore investing a long term? What will be the advantage? The advantage is very simple. So there's a company called PI Industries. Okay, this company was during those times, Rallies was one of the biggest, better company. Tata Group company was into agrochemical company, and this is the company which came. One of my friends is a director in this company. Now, this company, when it came and it would have invested, this is just about last, I think, in 2001, that is about 25 years back or 24 years back, you would have invested 1 lakh rupee, just 1 lakh rupee, your value would have been 50 crores today. This is the advantage of identifying good business, identifying value, and holding it back to the 10 years, and which is exactly what Philip Fisher has written a book called Uncommon Profits from Common Stock. If you have taken so much of hard work to identify a good business, valued it, and you have found undervalued stock, is better that you reap the benefits over a long term. Now, this another slide that I want to tell you. There are a lot of companies. Okay. Now, you have invested 1 lakh. This is the chart as of 2017. In fact, if I do it now, today, latest chart, the picture will be even much better. So if you have invested 1 lakh rupees, company called Symphony would have made 4.5 crores in 10 years. Avanti Feeds, this company, this is, all you non-vegetarians. This company has only one single product, and that is the shrimp or prawns. They only manufacture, or rather they prawns की खेती करते हैं, और prawns को जो feed लगता है वो ये बनाते हैं. That's it. They have no other business. And this company has, if you would have invested in 2007, today it would have been almost like 6 crores. I have put in here 3.3 crores, that is as of 2017. And there are so many. So there are so many examples where if you invest for a long term, your wealth can be multiplied. In fact, there are few stocks I can tell you. I was just telling Anamika a little while ago that there's this company 3 years back would come Mazgao Dog. Nobody had invested. In fact, that issue was kaise वैसे subscribe हो गया. Same is the story of Infosys long back, but this is the latest story. 3 years back, this company came with 160, 165 as an IPO price. And today, the price is 5,400. Just imagine, more than 30 times, just 3 times. So good companies, good management, good business will deliver return of sin. I am, she told you all that I am from Thane. So there's a company called Raymond's, which is in our vicinity. I stay very close from that particular, maybe just about less than maybe kilometer distance. 100 acres of land this company has. They got into reality. Okay. Now just imagine the clothing business or the apparel business is doing fantastic. If you go to second class towns, I think abhi bhi shadi hoti hai na, to dula Raymond ka suit mangta hai. Now that is the kind of company, that is the kind of brand equity that company has. Now when they came into reality, the amount of land that they had, and the price was 268, 260 rupees. That is the time that I entered into that particular stock. And today, that stock has businesses, which is the reality business, which is the listed one, and the apparel business, which is yet to get listed. I think it will get listed in somewhere in first week of September or so. Now, what has happened? That reality business today is worth 2,000 rupees at 268. And the apparel business, which is supposed to be listed at some market is expecting at 1,400. So just imagine 268 in just less than 2.5 times, 2.5 years time has become like more than 10 times. So this is how, you should, if you identify a good company, if you see that it is undervalued, stay invested for long term, and in long term you will definitely reap the benefits. Now, why I've been saying again and again that you should invest into good companies. Now, as you all doctors, I'm sure you'll agree with this line. It takes 20 years to build reputation, you know, and it takes just 5 minutes to spoil it. And if you have this understanding, trust me, you will think, you will do, or you will even say things differently. Even while investing also, invest in those companies who have built reputations, because those are the companies, those are the businesses are going to stay and stay for long. They are not going to ruin their reputation by doing anything which is hanky dory, at least in the near term or at least in the short term, because they're here for a long term. They're committed businessmen, they're committed companies to provide good products, good product service, and obviously they're going to help our economy to grow. So stick to those companies only, stick to those managements only. Don't get into the managements which are not into creating reputation, which are not into, they're only looking at, say, short-term profits. No, think long-term. Right mindset. What is, I'm going to come back. There are a lot of investors who would like to, become ultra rich almost like overnight. So there's a greed when you come into, stock market, and there's a fear also. Okay, I may lose money also, probably next day. So what is the right mind frame that you should have? As I said, long term. Why long term? See, this is a cycle of fear and greed. This is a psychological, chart. But this is exactly how a stock market that I've seen for the last 20, 25 years, how investors behave. First, they will come with an optimism. I'll take money, I'm going to make money. And the stock market goes up. So there's an enthusiasm. And then there's an acceleration that, yes, wow, whatever I've done, whatever I've touched, I've done, I have got a Midas touch that whatever I touch turns into gold. And that is a euphoria. And then the market start going down. And then you start become uneasy. And then denial, looks like, I'm not made for market, or aisa ho hi nahi sakta hai, ho sakta market. And then, market goes down, like during this Lehman Brothers crisis, everything was so bad and so dull that, the people, like, even I also used to say, after being in 20 years in the market, it's difficult, I'm not been able to understand the market at all. So a complete pessimism, and then panic. Panic means, a market like in Corona time, a lot of people thought, हमने 2008, 2009 में market देखा हुआ है, market has gone down, like, further it slips down. So let us get it, there's a panic, and in panic you try to do things which are not supposed to do, and ultimately you surrender, which is capitulation stage. And then lastly, despair. कि आज से कान को मैंने हाथ लगा दिया, I'm not going to be in the market at all. It is better that I work hard and make money. ये market में पैसा बनता नहीं. And this is exactly this fear and greed cycle works. You have to overcome, and you have to overcome and stay invested for a long term, because you have to invest that amount of money which you want to need only after 40 years, 30 years, 50 years, depending upon your age, because this is the money that you're going to use. Substantial part of this money you want to, put it to a next generation. Like, for example, I'll give an example. My very close dear friend Rakesh Jhunjhunwala, for example. Now, Rakesh Jhunjhunwala, he's been investing from the age, I think, 12, 13. He's also incidentally chartered accountant. Now, whatever money, 44,000 crore that he died when he had that wealth, now he has used certain part of money, but substantial part of his money he has put on to the next generation. So similar thing is going to happen if today onwards you all start investing in order that I am saying. Trust me, substantial part of money will go to your next generation, but part of your money that you're going to use it. And that money, is going to come only, or that sort of money is going to come only if you're going to invest for a long term and coming out and becoming completely neutral to all the emotions as per the market. So my next slide is talk about, whether you should take advice from professional or not, whether you should do it yourself or not. Trust me, you don't, like, for example, if I have a problem with my heart, so I'm going to go to cardiac specialist, correct? If I have a problem with my tooth, I'm going to go to a dentist. If I have a problem with any of my, so I'm going to go to specialist. Reason being, because he's the expert on the subject, and he's going to give me solution which is needed or which is best for me. Similarly, in investment world also, I think you need to have a good trusted friend or advisor with you all the time. Reason being, honesty is a very, very expensive gift. And you can't expect from cheap people. I'm not here going to put because I saw that it has been recorded. So I'm not going to talk. There are a lot of bankers who come to talk to you about your investments. They seldom sell you correct product, and they will only sell product where they make money, they meet their targets, and they will not look at your interest. Your interest is the last. Their interest is the first. So how can I expect an honesty from them? And these are the two lines where in Indian context, a lot of rich take advice from relationship managers, which has been graduated from a business schools. What knowledge he has, what kind of market cycle he has seen, how he will hold the investor's hand during troubled times. He can't. So please don't avoid fees, but please do avoid the bad advice that you may come across. And why? See, stock market is a place where you will have opportunities. Now they're saying that when it rains gold, put out a bucket. Don't go with thimble. So when you can keep investing on a regular basis, but whenever market throws an opportunity, make most of it. And market with opportunity, aati rehti. I was traveling to Surat, and one group of investors who met, and I learned that from there. वो बोलता है, you know, in market, the opportunities are like a crop season. So every year there will be some crop or the other. So you have to keep grabbing those opportunities. Don't sit on cash. Cash is absolutely not king, because and I've taken this slide particularly since you all are medical professional. I don't know how many of you practice. Keeping cash can only attract dust, nothing. So whatever you have money, every money or like you're working hard to earn that money, or whatever income that you're making, that money that you save should also work extremely hard, or maybe much harder than you to make money for yourself. And that is the reason why you should say invest at all times. Stock picking, as I said, that you need to, there are a lot of books on the investments. There are a lot, in fact, right from Warren Buffett. Warren Buffett, sorry, has not written a book. Mary Buffett, it's his daughter-in-law who has written a book with Cian David. Now, what she has put in the book is a lot of dinner conversation which she had with Warren Buffett. And there are a lot of learnings. And those learnings one can apply into stock picking or stock investment, and you can make tons of money. Reason being, because you will make certain rules. And see, like, I personally feel medical field is more complicated than investment. Investment is very simple. You just invest, stay invested, and just sit tight. That's it. So long you have invested, so long you have dealt with a good person, good management, good CEO, good business, good market, everything good, trust me, you will make money. So you have to make a deal with only good people, because you really can't make a good deal with bad person. So you have to just only avoid those bad, companies or a bad deal makers. That's it. Another thing, extremely important, all these books, I can rattle almost like 32 hours. I can send the list to Anamika later on. All these books talk about only one thing, that you can do it yourself. Investment is far more simpler and far more easy topic. Making money is the most easiest thing in this world, I believe. And that is, trust me, last 25 years, I only know that particular job. And I think it is the most easiest thing to do. I'll just probably on a lighter note, somebody yesterday asked me, I went to meet one of the businessmen, and he was asking me, how come, whenever I call you, you normally respond, and you also give me enough time that I needed. I have told him, listen, boss, I'm not busy as you. The reason being, I have invested in 20-25 companies, and those 20-25 companies are doing extremely great job for me, and they are making money for me. Why should I work hard? As simple as that. This stage has come because I have invested extremely high in me by going through a lot of books. So I think the best investment one can make by investing in oneself. So the more you learn, trust me, more you learn. So keep investing, keep reading as much as possible, keep talking to people. I normally go to any factory. or any CEO, I will understand the business. I will understand the nuances of this business. I will understand the critical things of this business, and that is how. And then I'll come back and probably I'll learn. I'll read lots of reports on that company, and probably I'll go through some of the critical part of that business. We'll try to understand, get some expert. Like I wanted to invest in a pen company, so I could find out there's one person who was advisor to Asian Paint. So I went and I understood the chemistry of how this pen pigments have been done and what kind of future it is there, etc., all of that. So, I think what is more important and what is the point that I'm trying to drive is invest in yourself. Trust me, it is the most important thing and most, wealthy thing that you'll be doing it to yourself. Investments and speculation. These are the two different animals. There are a lot of people will come across and they'll tell you, boss, I keep trading in the markets and every 6 months I make money double. If that is true, you do it yourself on an Excel sheet. If every 6 months somebody is making money, and if you start with just 10,000 rupees at the age of 35, trust me, at the age of 45, that is 10 years from the point that he has started, he'll be the world richest person. But he is not. He isn't. Why isn't? Because it's a zero-sum game. Speculation doesn't help. Speculation has only one way, and that is, it will make you poorer and poorer. Investment is the only road which will make you succeed. So understand the difference between two and get into only investment, zero speculation. Now, another thing, I thought I must bring in this circle of competence. Now, I'll give an example of Warren Buffett. What Warren Buffett says, that I've invested in Coca-Cola because I love Coca-Cola and I drink myself, I consume myself. If I have any visitor to my office, I give Coca-Cola to him. And Coca-Cola has been manufactured, sold across the globe. Okay. And what best I understand is Coca-Cola is been manufactured for a cent and been sold for $1. And, they sell almost like 1 million cans of Coca-Cola almost every second. So 1, 2, 3. Now 3 million Coca-Cola cans have been sold and millions of dollars have been made. So that is the kind of business that he's invested in because he understands this business well. So what it says basically, these are the three competence. The center one is basically what you really know, you think, and you actually. Now, second circle is you think you know, but actually you don't know. And the last one is, of course, you don't know, and you also know that you don't know. You start with the middle circle. Like, for example, you all are medical professionals. So maybe medical business, this hospital business or the pharmaceutical business, the pharmaceutical molecules or some of the research companies that you'll know well, no doubt about it. So you start there, but as you grow, you have to start looking at outside that, comfort, that is the central circle, and start expanding. And that is how your circle of competence can increase. So you start with something which is basic that you know, like I'm a chartered accountant, so I understand bank stocks well. But while understanding banking stocks, a bank is very simple. They borrow money at X rate and they lend money at Y rate. And the difference between two is their profit. But while understanding this, I understood the impact of, interest rate movement. If the interest rate goes up, so obviously, bond prices fall down and therefore bank treasury falls and therefore they make losses and vice versa. So while understanding this, I also understood if interest rate goes up, means my EMI will go up, and the EMI goes up, that means housing stocks will fall, car stocks will fall, and so and so. So that is how my circle of competence will keep increasing. Whatever happens in the market, whatever noise in the market, Modi is going to come, Modi is not going to come, Rahul Gandhi is going to come, or Rahul Gandhi is not going to come, or some war between Russia, Ukraine, US is not supporting us, Russia is supporting us, etc. So all these noises are made by, speculators, market traders, only to take their situational advantages. So just forget about, so ignore the market, ignore the economy, and just buy business that you understand, you think that it is going to grow. Trust me, you will make money. And that is how it is. Now, I'm going to come back. This is my favorite part. And, my introduction when she read, my daughter is doing law and my son is doing chartered accountant. He finished chartered accountant. He's working currently now with KPMG. So, I believe in giving my kids enough so they can do anything. My son also has launched some clothing brand also, so I've helped him, but not so much that they can do nothing. I think that is dangerous. So what you do with so much of money that you have accumulated or made? My submission to all of you and my appeal to all of you is you must do charity, little bit, whatever. Even that 1 rupee that you donate, trust me, it will go for a good work. Why? Because we are staying on this earth. I think we have to pay some rent. So this is the rent that I am paying, or you should all pay, because we are one of those few luckiest people, maybe 1% of humanity, and I think we owe to the rest of the humanity, which is 99%. And that is the reason why whatever money that we make today, I think some part of it you should donate. You need to have smart habits. I don't have to tell you because you all are smarter than me. The difference between successful people and very successful people is that really successful people say no to almost everything. So if somebody comes to you with any option, investment option, or kuch bhi ho, first you study it. Don't say yes to it, because once you write a check, you can't go back. And Warren Buffett says that every proposal that comes to me, I always reject, because I'm not going to invest in more than 20-25 companies. Correct? So I'll get hundreds of proposals. So the proposal that I understand most, proposal that qualifies my rules that I made before investing, is what I'm going to consider, not invest, consider. And if I like it, and if I think that I'm going to make money out of it, yes, I'm going to invest it. And for that, it is better to hang out with people who are better than me. We have to pick out our friends, associates, the people that we deal with better than us, so that we can drift in that direction. We can learn things from them. We can be better every day. Because of time, I am being really rushing. Otherwise, I have lots of stories on this. And since I believe Anamika said you all are salary, you earn salaries. So since as a chartered accountant, I'm saying that this is the options that you have. PPF, which gives you around 8.5% kind of return, which is tax free. ELSS, which is the equity linked savings scheme. That's the only option amongst these investment options. There are only two options which are equity options. One comes under ELSS and the other comes under ATCCD, the pension plan, which is, I think, some 4-5 years what government has introduced. So my submission to all of you would be, invest into ELSS. Don't get into this fixed deposit. It is nonsense. Insurance only for protection, but don't mix insurance with investments, because the cost that you pay is pretty high. And try as much as possible to save taxes. Planning is, if you plan well as your taxes, the tax incidence on you will come little less, and you know exactly where to invest. Life insurance, one of my friend has sent me this slide. It obviously covers your life. It eventually protects your family from that eventuality, which may happen or may not happen, but at least it gives you a little bit of confidence to do certain things in a certain way. It grows your money, of course. And there are a lot of people who use wealth accumulations and for children's higher education, marriage, retirement planning, legacy planning, all of this for insurance. But I personally feel you should look at selectively, you should look at your own individual needs and then take the informed decision. Now, in conclusion, as I said, I started with those financial challenges that you have. So not everybody will have all the challenges. Somebody may already have a house, or somebody may just inherit a house, or whatever. So whatever your challenges are there, define them well. So those becomes your financial goals, and you don't have to waste even a single minute. You have to start investing immediately. Invest regularly, because that's how you earn. Invest for long term. Long term, you'll always make money. Invest in yourself. Become more and more, educated in terms of finance. I'm sure you are best brains in the world, best brain in our country and the world. But financially also, you need to get yourself equally equipped. Avoid bad investment. If you have done bad investment, I think it is good to say that avoid bad investment. But there are times that you may make mistakes. Accept the mistakes and take corrective action. There are a lot of people who say, one घड़ी भी दिन में 2 बार सही टाइम दिखाती है, तो कभी ना कभी मेरा ये प्राइस, वो जो स्टॉक मैंने इन्वेस्ट किया वो आएगा. ऐसा नहीं होता है. Sell that stock, accept that mistake and move ahead in life. Stick to your strength and rules that you have made for investments. If you have said that I'm going to invest See, like for example, I have made one small rule that I don't invest in any company which has cash income. Companies which generate cash, I don't invest. Reason because I don't know how much is uh, accounted or not accounted for. So I don't invest. And most important, when you invest, I know you're investing for long, but don't sleep over it. Keep monitoring, whether it's monthly, don't do it every day, but at least monthly, quarterly, half yearly. Monitor, monitor, monitor. If you have made changes, if you want to make changes, please make it, and that's it. And lastly, which is very important, that at least half a percentage or 1% of your total income that you make in a year, you must put that money for some good use, and that is charity. Do it. Trust me, you'll have a good satisfaction at your heart that you have done something for the society and for yourself. And my last signing off slide is, if you don't find a way to make money while you sleep, trust me, you will work until you die. Thank you so much, friends. If you have any questions, I think Anamika, you can open this for questions and answers.
Yes, sir. Thank you so much, sir. That was such a wonderful session. Like, I'm sure that the audience has gained a lot from this. And yes, there are plenty of questions. The first question is, what is the difference between CAGR and XIRR?
Okay, I think it's a more like a CAGR is a compounded annualized growth rate where the formula is used is 1 plus R raised to N, where R is rate of return and N is the number of years. Whereas IRR or XIRR, it is the internal rate of return. So basically, it's a return at which your investments are growing. So basically, in IRR, you take into account your outflow of the, like for example, you have invested 1 lakh, so that's your outflow. And what are the cash flows? If the cash flows are irregular, then you use XIRR, and if your cash flows are regular, then you use IRR. And if your cash flow is like a bullet, like you invested today, and if you invested, you're going to get money after 10 years, then it is a CAGR. I think that is the mathematical formulas basically. So this is basically the difference.
So another question is, how do you know what stocks are undervalued?
Oh, so that is basically an art of understanding. It's like this, how much money you are likely you want to pay. For example, I took an example of iPhone. So if iPhone price is not discovered, and if iPhone isn't put on a say in a showcase or say in a shop, and if you ask anybody question as to how much you are willing to pay for this, so somebody may say 20,000, somebody may say 2 lakh also. So the value is a perception. So like for example, if I'm going to if I invest in a particular company 20,000, that same iPhone, and if I'm going to sell that for 25,000, so for me 20,000 is a value and 25,000 means minus 5,000 is a profit. So it's a perception. But there are a lot of models which are used in financial world. Like one is a capital asset pricing model, then discounted cash flows, DCF valuation, and there are net asset method. Then there are simple, the asset carry methods. So these are the methods which have been used to find out what is the value. Now, for example, I'll take an example of, say, Raymond, for example. If Raymond has 100 acres of land, okay, and today, if their stock, the reality stock which is there right now, which is listed at some 2,000 crore ka market capitalization that company has today at the price of 2,000. Now, if from 100 crores, if they're going to generate revenues of say 15,000 crore, so that means in future, from 3,000, this company should be valued at 15,000 crores today. But that 12,000 additional revenues are going to come in over a period of 10 years. So I'll discount it. For example, if similar money, if I have to invest anywhere in the risk-free asset, I'm going to get 7 or 8%. So I'm going to discount that 12,000 at 7.8, 7 or 8 percentage today and find out what is the present value. And then I'll add to the current value. And I'll see if this value is say 3,000, that means this stock is undervalued by 1,000 crore. Or if that value, if it comes after 10 years, say 1,800, that means the stock today at 2,000 crore is overvalued by 200 crore. So that is basically, it's a very technical subject, but it's very difficult to find out what is undervalued. But like for example, in stock market, if you look at, there's something called, they give you book value. So if book value is 1, if the share price of that face value is 1 and the book value is 1, that means it's a parity. And if book value is less than 1, that means it's undervalued stock. But unfortunately, book value doesn't capture the current market value of the assets that company holds. So therefore, there is a that lacuna. But you'll have to do a lot of number crunching to understand and arrive at a value. So that is called that's a big subject. Maybe I can talk 1 hour on that. So maybe some other day.
So another question is how to select equity.
How to select?
Equity.
How to select as an equity? If you want to stay in, if you want to invest into equities, I mean, you need to have a demat account and you need to have a trading account and you need to have a bank account. All this is linked, and you select stocks and you see. In India, there are two Sensex or two indices which are very popular. One is Nifty, which has 50 stocks. So these are top 50 companies of our country, and BSE Sensex has 30 companies. So these are the top 30 companies in our country. So typically overlapping pakad ke around 52 stocks are there. Now, this 52 stocks, if you believe that these stocks generally, good companies will, since these are large companies, they will generate return between 12 to 15% over a period of next 10 to 15 years, irrespective of whichever company you select. So you, once you have open account with this, you can, depending upon your understanding on the markets, depending on your understanding on business, you can just select any stock and invest. Or you can use professionals like us or any of your friend who's into financial advisory services, you can go and talk to me. I think that is the best way to do it. But you know what? Like, for example, it is like asking, how do you do operation? So, or surgery. आपने 4 साल की मेहनत की है पहले तो MBBS करने के लिए, उसके बाद MS करने के लिए, I'm sure you would have spent another maybe 10 years or so, including your practice and all of that. So it is art, and I want you to appreciate it and go to the professional to take that advice.
Okay, sir. So another interesting question we received is, with all the knowledge you have today, assuming you're a 25-year-old with 1 lakh rupees, how will you invest that money?
I will invest entire my money into equities. So what I'll do, there's a way of doing it also. Like I just said that you should go to the professional. But friends, I must tell you, there are professionals which are available in the market in the public domains also, and they're called mutual funds. What mutual fund does, they do exactly the work that you're supposed to do, and they charge you 1% asset management fee for the money, for the job that they do, and plus 1.5% or 1.2%, 2% depending upon the fund size. So that is their expenses, and they invest. So I think you should straight away select a good mutual fund and invest into that mutual fund and stay invested. I think some of the mutual funds have done wonderful job. Maybe I think Anamika, next time, maybe you can do something. Maybe next quarter or so, I can do a small presentation on mutual fund for about half an hour or so as to how to select a good mutual fund, because there are 1,800 or 2,000 plus schemes are there, and selecting good mutual fund also is extremely important. Now, if somebody doesn't want to become, हमारे country में कैसा है ना, every investor, not greed factor, but ये दिल मांगे more. If you want to invest into stock market, the best thing is Sensex or Nifty. So you can just buy index fund and forget about it. So whatever index gives you return, or whatever Nifty gives you, or BSE Sensex, that return to anyway you're going to get. But if you want more, then you have this problem of how to select a good mutual fund. So I think we'll do a separate session as to how to select a good mutual fund then.
Yes, sir. Sure, sir. And another question is, what part of our salary should we invest?
This is the question should have been otherwise. How much money I should spend? There's a saying, you save first money, and whatever money is left, that you spend, not the other way. So there's this Jewish jar system. So what Jews, worldwide Jews are supposed to be the richest people. So they have this investment Jews jar system. That is what they follow. What they do, 1/3 of the money that they spend on the current kharcha. The current expenses have been taken by 1/3 of the money. 1/3 they invest for the future generation, and 1/3 they invest for the current generation, which is basically your retirement fund. And that is how it is. And they are most successful investors world over. I think Warren Buffett is also one of the Jewish ones.
Okay, so like a last question on a recent update. Since income tax has been increased on long-term investments, how do you look at this? Is one of the questions.
Friends, I know short-term capital gain was earlier 10%, now it's going to be 15%, and long-term capital gains, uh, uh, short-term was 15, now is made 20%, and long-term, which is 10%, now has been made 15%. And on properties, indexation has been removed, and you have to pay 12.5% tax. Now, indexation, property ka to, in fact, it is advantageous to pay 12.5% tax because your assets have been set at 2001 prices. So obviously going to benefit out of it. The benefit is hardly 4 or 5%, but still you want to make money. Now, coming back to the investments, on investments, this 12.5% tax, the 20% tax and 15%, I think it is still the lowest. Reason being, I'm saying that this is you are at a control as to when to pay tax. I'm the one who's been advising long-term investments. So you are not going to disinvest. You're going to only use this money at some point of time once only, and you have to pay that tax only once. Unlike your salary or other income like interest or even rent, all of these are taxed every year. In fact, interest ऐसा है कि आपके हाथ में आए या नहीं आए, whether you get that into your account or not, you have to keep paying taxes on an accrual basis. Same is for a rent also, and same is for salary also. So in fact, these capital gains are still at the lowest, and I keep reading a lot of WhatsApp jokes on it कि इनकम तो हम करते हैं उस पर तो टैक्स भरते ही है, बट वो इनकम में टैक्स भरने के बाद जो पैसा देते इन्वेस्ट करते हैं उससे जो इनकम मिलता है उसमें भी टैक्स, बट दैट इज हाउ इट इज. And only one tax. So it is still on the lowest side, especially on if you look at the globally, I think our taxation is still relatively at a lower. And most of you, you must remember, what was the highest tax rate? Do you know? The highest tax rate in our country was 97.5%. So if you earn 100 rupee, you will get 97.5 to the government, and 2.5 is what you left with. I think we are better off now that 100 rupee में से कुछ 40 रुपए चला जाता है, all taxes put together, 60 rupees left with us. So I think we are at a better situation. So we shouldn't be worried about too much on taxation.
Okay, so thank you so much. After hearing all these questions, sir, do you have some final words to tell to our audience today?
No, I think I was more like a mono, but my humble request to all of you is that whatever little that you can save, keep saving it, because this is what if you want to grow our economy, you want to grow our nation, I think this is the biggest contribution that you will be doing by investing. Our investment savings rate at once upon a time was 40%, 38%, which has come down to now almost like 21, 20%. In fact, it had gone down to almost 18%. Now it has again gone up. Now, why saving economy always helps? Government needs to put a lot of efforts in terms of increasing infrastructure, increasing capex, and for that they need money. And this is the money which goes like whatever money you invest in the stock market or wherever you invest, this money ultimately creates something. So it creates the underlying assets or creates something. It is used to produce. It has been used to produce something. Like gold, if you invest. Gold you have bought and just bought it and kept it at home. It doesn't produce anything. It just stays at home. That's it. So so invest into assets which are productive assets. And the stock market is one of the greatest product, and they always call it a mirror of an economy. So you must keep investing whatever little you can, and it's good for you, good for economy, good for government, good for everyone.
So thank you so much, sir, for this wonderful session. Because of time constraint, I think we'll have to end this now. On behalf of KM Mart and BMC Mart, I would really like to give a huge thanks to you because this webinar was really enlightening, and I'm sure that our audience has learned a lot from this. I'd also like to thank participants for being so active, and we have so many questions, but unfortunately we don't have time. So again, thank you so much, sir. So yeah, I'll be ending it. I hope you all have a great evening. Have a great evening, sir. Thank you.
Thank you for the opportunity. Thank you so much.
Thank you.
Bye-bye.